Hi, welcome back. Today we're talking about a stretch of water that's only about 33 miles wide at its narrowest point, and yet it has the power to move oil prices, silver prices, and even your monthly budget almost overnight. I'm talking about the Strait of Hormuz, and if you've been watching the news over the past several months, you already know this narrow passage between Iran and Oman has been at the center of one of the most tense standoffs the energy world has seen in years. What happens there doesn't stay there. It ripples outward into gas pump prices across the United States, into the cost of shipping goods, and into the precious metals market that so many of you follow closely on this channel. Let's break this down from the beginning, because understanding why this one stretch of water matters so much is the key to understanding everything else that follows. Roughly a fifth of the world's oil supply passes through the Strait of Hormuz every single day. Tankers loaded with crude from Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Qatar all funnel through this single corridor before heading out to refineries around the globe. On top of the crude oil, a significant share of the world's liquefied natural gas also moves through these same waters, mostly coming from Qatar, which means any disruption doesn't just touch gasoline prices, it touches natural gas markets too, and by extension, home heating and electricity costs in parts of the world that rely on that fuel. There is no easy detour. A few pipelines exist that can bypass the strait, running overland through Saudi Arabia and the United Arab Emirates, but they can only carry a fraction of what normally flows through the water each day. So when tensions rise near Hormuz, the entire global energy system holds its breath, because there simply isn't a quick backup plan if the flow gets seriously interrupted. Geography made this one narrow passage almost impossible to replace, and that's precisely why it keeps showing up at the center of these stories decade after decade. Now this is important because earlier this year, tension in the region escalated into open conflict. Since the end of February, the area around the strait has seen military strikes, missile exchanges, and warnings from Iranian forces that ships passing through without authorization could be treated as targets. Multiple commercial vessels were damaged in the weeks that followed. Sea mines were reported in parts of the waterway, and shipping companies had to make difficult decisions about whether it was even safe to send tankers through at all. Insurance costs for vessels traveling through the region reportedly climbed as risk assessments were revised, and some of the world's largest oil trading houses temporarily paused shipments altogether while they waited for clearer information about conditions on the water. Traffic through the strait, which normally sees well over 100 vessels a day, dropped sharply at the height of the tension, with some reports describing only a handful of tankers willing to make the crossing on the worst days. Naval forces from several countries, including the United States, increased their presence in the area to help escort commercial shipping, which is itself a sign of just how seriously governments were treating the risk to global trade. Think about it this way. Imagine the one highway that connects a major city to its only source of fuel suddenly becomes a place where trucks are getting shot at. Even if most trucks still get through, drivers start avoiding it, insurance costs skyrocket, and the whole supply chain slows down out of pure caution. Now multiply that by an entire global economy that depends on a steady, predictable flow of energy, and you start to understand why markets react so quickly to even the possibility of disruption in this particular stretch of water long before any actual barrel of oil fails to arrive at its destination. Here's what this means for oil prices specifically. When the market senses that a meaningful percentage of daily global supply could be delayed or blocked, prices react immediately, often before a single barrel is actually held up. Traders aren't just pricing in what's happening right now, they're pricing in the risk of what might happen tomorrow. That's why you saw crude oil prices swing sharply higher during the most intense weeks of this conflict, and it's also why prices eased back down when there were signs of de-escalation. Over the past week, reports have pointed to a pause in hostilities and renewed diplomatic talks involving the United States, Iran, and regional partners like Oman and Saudi Arabia, all focused on restoring safer passage through the strait. As those talks progressed, oil prices pulled back from their highs, which tells you something important about how these markets work. They don't just respond to events that have already happened. They respond to expectations about what comes next. So where does silver fit into all of this? This is where a lot of newer investors get a little confused, because silver isn't an energy commodity, it's a precious metal, but it actually sits at an interesting crossroads between two different forces. On one hand, Silver behaves like a safe haven asset during moments of geopolitical stress, similar to gold, because investors look for stores of value when the news cycle feels unstable. On the other hand, silver is also a heavily used industrial metal tied to solar panel manufacturing, electronics, and a wide range of factory processes that depend on affordable energy. When oil prices spike because of a supply scare like the one we've seen around Hormuz, it can raise input costs across manufacturing, and that same uncertainty tends to push investors toward metals they view as more stable stores of value. That combination is part of why you've seen gold and silver both catch bids during periods when Middle East tensions were running hot. Now this is important because it's not a simple guaranteed relationship. Precious metals prices are influenced by a long list of factors working together at the same time, including Federal Reserve policy, the strength or weakness of the U.S. dollar, central bank buying around the world, and broader investor sentiment about the economy. Geopolitical tension around a choke point like Hormuz is one ingredient in that mix, not the entire recipe. In fact, over the past week, as diplomatic efforts appeared to ease some of the worst fears about a prolonged shutdown of the strait, we actually saw an interesting split in the markets. Oil prices dropped noticeably as supply fears cooled off, yet gold still pushed higher, climbing back toward the $4,100 level after pulling away from a multi-month low. That tells you gold wasn't only trading off the Hormuz headlines, it was also responding to broader questions about interest rates, currency strength, and where investors expect the economy to head next. Let's talk for a moment about why oil and precious metals don't always move in lockstep, even when they're reacting to the same underlying event. Oil is a physical commodity tied directly to supply and demand for actual barrels moving through actual pipelines and tankers. When a threat to supply eases, oil can fall quickly because the physical risk that was priced in starts getting priced back out. Gold and silver, though, are also monetary assets. People hold them as a hedge against currency risk, inflation uncertainty, and broader macroeconomic anxiety, not just as a reaction to a single headline. So even after a specific supply threat like a Hormuz disruption starts to calm down, metals can remain elevated if investors are still worried about other things happening in the economy, like the direction of interest rates or ongoing questions about government debt and spending. If you're finding this kind of breakdown useful, go ahead and hit that subscribe button because we cover these connections between global events and precious metals markets on a regular basis here on the channel, and it genuinely helps more people find these explanations when you engage with the video. Let's zoom out and talk about risk and perspective, because it's easy to get caught up in dramatic headlines without stepping back to see the full picture. It's true that the Strait of Hormuz situation created real disruptions this year, with damaged vessels, halted shipments, and a level of uncertainty that hadn't been seen in the energy markets in a long time. At the same time, it's worth remembering that global energy markets have weathered choke point crises before, and there are structural buffers in place, including strategic oil reserves held by several countries, alternative pipeline routes, and diplomatic channels that tend to activate quickly once tensions threaten global trade on this scale. Regional governments and international shipping organizations have also worked to establish safer transit corridors when possible, and that kind of coordination tends to bring at least some stability back even while underlying political tensions remain unresolved. None of that means the risk isn't real, but it does mean the situation isn't purely one-directional. Prices can spike on fear and then normalize just as quickly once the underlying threat eases, which is exactly the pattern we've started to see in recent days as negotiations progressed and both sides signaled a willingness to step back from further escalation, at least for the time being. A simple mental framework that can help you follow stories like this going forward is to separate what's happening from what's being priced in. What's happening is the actual physical situation, ships either moving safely through the strait or facing real danger, oil actually flowing or actually being delayed. What's being priced in is the market's collective guess about how that physical situation might change in the days and weeks ahead. Most of the sharp price swings you see in oil and precious metals come from that second category, shifts in expectation, not necessarily from a dramatic change in actual barrels delivered. Once you start watching for that distinction, headlines become a lot easier to interpret, because you can ask yourself whether a price move reflects something that's already happened or something the market is simply worried might happen. Looking ahead, There are a few different ways this situation could unfold, and it's worth holding space for more than one possibility, rather than assuming any single outcome is guaranteed. If diplomatic talks continue to make progress and shipping traffic through the strait returns closer to normal levels, you'd likely see oil prices settle into a calmer range.
And some of the safe haven pressure supporting gold and silver could ease as well,
though other factors like interest rate decisions would still be in play. On the other hand, if talks stall or new incidents occur near the strait, you could see another round of volatility across both energy and metals markets, with oil spiking on renewed supply fears and precious metals catching a fresh bid from investors looking for stability. There's also a middle scenario where tensions simmer without fully resolving or fully escalating, leading to a choppier, more sideways pattern in prices as markets wait for clearer signals. None of these outcomes are certain, and anyone claiming to know exactly how this resolves is getting ahead of what the situation actually allows anyone to know with confidence. So how does all of this connect to your actual life and your actual money? For most everyday Americans, the most direct impact shows up at the gas pump and in the broader cost of goods, since oil prices influence transportation costs across the entire economy, from trucking to shipping to manufacturing. Higher energy costs can filter into the price of everything from groceries to home goods over time, since almost every product on a store shelf traveled by truck, ship, or plane at some point before it reached you. Even a modest, sustained rise in fuel costs tends to show up weeks later in shipping surcharges and retail pricing, which is part of why energy markets get so much attention from economists trying to forecast where inflation might be headed next. For those of you who hold or are considering precious metals as part of a diversified approach to protecting savings, understanding these geopolitical drivers gives you better context for why prices move the way they do, rather than reacting emotionally to every headline that crosses your screen. Markets built on fear tend to overreact in both directions, and having a calm, informed perspective is one of the most valuable tools you can bring to any kind of long-term financial thinking, especially during stretches when the news cycle feels particularly intense. It's also worth remembering that events like the Hormuz standoff are a reminder of how interconnected the global economy really is, a conflict thousands of miles away, in a stretch of water most Americans have never seen, can influence what you pay to fill up your car and how the value of an investment in your portfolio behaves over the following weeks. That interconnectedness isn't something to fear, but it is something worth understanding, because the more clearly you see these relationships, the better equipped you are to make thoughtful decisions rather than reactive ones. To bring it all together, the Strait of Hormuz remains one of the most consequential choke points in the global economy, and the tension surrounding it this year has shown just how quickly oil markets and precious metals markets can respond to both fear and relief. Oil reacts most directly to the physical reality of supply and shipping risk, while gold and silver respond to a broader mix of safe haven demand, monetary policy expectations, and investor sentiment layered on top of that same geopolitical backdrop. As diplomatic efforts continue and the situation around the strait keeps evolving, staying informed rather than reactive is going to serve you far better than chasing every headline. I hope this breakdown gave you a clearer picture of how these pieces fit together. If it did, consider subscribing so you don't miss the next update as this story continues to develop, and I'll see you in the next one.